Hey guys, Freaky Finance here. Today we're going to do Nutrien. A couple weeks ago we did Disney. Nutrien's been on the hit list for a while, but like with a lot of commodities, I like to take my time and go through them. This is more of a first look. I'm going to dig deeper into the supply-demand dynamics for potash and nitrogen. But for today's video, I figured I'd get it out here because, one, I started positioning it already, and I'm going to just kind of show like why and kind of how I think about commodities in general, especially when they start coming out of favor, and start showing things that I like to see in terms of a bottoming process. Now, usually commodities, the last couple videos when we did commodities were more about copper, and then before that was oil and nat gas. The thing is, they go up more than they should, and they go down more than they should, both the commodity and the stocks that ride them, and the stocks that ride them even more so. So they'll go down more than you think they should, and they'll go up more than they probably should. And that's just the nature of the beast. So with that in mind, let's jump through it. Another side thing, I'm thinking about changing it up and taking off the mask and the raincoat, but we'll see. I'm kind of on the fence about it, because it's kind of the channel's got to 20,000 subs and start putting out more videos instead of a hobby. Anyway, so Nutrien, the reason why I'm looking at Nutrien before is that what I like to do is garden things. So there's always things in the portfolio. This is just a bunch of random stocks, but some of them link to commodities, which is why I pulled them this way. But anyway, so Nutrien, I started a position, so full disclosure, own some, average at 65.65. And I'm probably going to keep adding under 60, but I'm going to get more familiar with it at the time. Like I said, they probably get cheaper than they should. And one of the things I'm doing right now is so we've seen defensives start getting a bid, rate sensitive ones that are like, oh, interest rates are finally not going up, they're going down. So we're seeing like the utilities finally get a bid, we're seeing the AT&T get a bid. And those are two that I think I've did videos on the channel in the past. So anyway, those are hitting near 52-week highs, so I start looking for things to sell and switch into things that are at 52-week lows, like Nutrien and Vale. So that's kind of the thought process behind the video. And so I'm most going to Nutrien specifically in a deal, but like that kind of how we did with Suncor when oil was actually rebounding during the COVID panic and their price was still lingering. You got about 4 or 5 months there to pick up Suncor, and I've pretty much trimmed that down to nothing now. And what I do with that is buy other things, obviously. That's just the gardening, like trim and buy the next thing, because capital is competitive, right? And there's always probably a better idea out there if you just look hard enough. Same thing could be said for Tourmaline and Advantage. So the nat gas plays, again, we've been trimming them over the last years and buying other things, copper as well. We trimmed a lot of the Freeport. I think I did a video on that one as well at some point. And the idea there is to pick up the next thing that's under pressure. So right now we have Vale, iron ore under pressure, Nutrien, potash under pressure. So they're just ideas that I'm thinking out loud about. So anyway, and so here you can see I'm thinking about selling more. ATCO, I've already trimmed ATCO twice, and I've already trimmed AT&T 3 times. And basically the idea is just to take these ones and start putting them into the ones that are hitting lows. And I'm probably going to continue to do that. And that's where the money's going to come from. So that's just kind of how I think about things. Doesn't mean it's right, this is just what I do, and it's worked for me over time. Okay, so back to Nutrien. This video is going to be a little bit longer. We're not going to go into too much detail about the dynamics of the commodities, because honestly I need to do more work on them. But anyway, so potash, Saskatchewan, so 6 mines in Saskatchewan. It's all potash. Nitrogen is spread out, but again, this is actually in Alberta. And then for potash, for phosphate, it's largely in America. Then they have a retail network all over, and we'll bring up Brazil as well, because that's the reason why I think there's more pressure than there otherwise would be. But we'll jump into that when we can. Here's another map. I'm a sucker for maps. I like to see where the assets are, because it helps me visualize what's happening over time, even if it's a commodity play, where at the end of the day the price is going to dictate the stock, the price of the commodity rather. So I kind of focus on the ones, again, orange is potash, which is, we'll go through this segments in a second, but that's one of the bigger segments. Nitrogen's another big segment, and then the retail's all over the place. So you can see in terms of orange here, Saskatchewan. In terms of nitrogen, the blue, largely Alberta, but you have it spread out Texas, Louisiana, phosphate on the coast there. Again, there's just another map, and you can see the retails in Brazil, retail in Australia as well. In terms of what I always like to do is see the segment reporting just to kind of tell you what segments are important. In this case, there's 3 critical ones. So it's fairly diversified across these 3 channels, the potash, nitrogen, and the retail side. You can see this is during the Russian invasion of Ukraine. That price has shot up even further, especially for potash and nitrogen. And you can see that here in the EBITDA. And now we're on the flip side of that, is when they get cut in half, if not more, year over year. So we had a horrible comp already in 2023, and now we're still having a horrible comp in 2024. And what I like to do is how cheap can the stock get during that time? Because eventually it's going to, just like everything, it's going to mean revert. Quantities always mean revert. So it's worth bringing that up, just to kind of see where we're at in the time and what segments are the most important. Phosphate is important, but relative to the size of the others, it's just not critical to being right on the investment. So if anything, I need to know more about the supply-demand characteristics of these 2 quantities. Here's just another way to show the same thing. You can see the EBITDA, potash, the biggest one, followed by nitrogen, followed by retail. In terms of employees, though, you can see retail has a lot of employees, and it has a lot of the revenue. So, but in terms of profitability side, potash, nitrogen drive a lot of the profits, so higher margin. All right, so that's just kind of how I cookie cutter things, just because I go through so much information at a time, it kind of helps me visualize what's important right now. Just how I categorize things in my head. So I like the potash, so it's potash biggest segment, and I go into where the production's the biggest, and there's the 6 sites in Saskatchewan. The biggest for production is the Rocanville potash one. So I go where it's at, because I'd like to actually see them. So it's near the border of Winnipeg, between Winnipeg and Saskatchewan, and that's what it looks like. So again, I'm just a visual person. I did the same thing if you watch the copper miners up to see where they are. Even with Freeport when we were doing trying to figure out the Indonesia mine, Grasberg. Go in there, right? And the Chile ones too. But yeah, anyway, same idea. So I like to see, okay, this is what the plant looks like. This is actually, funny enough, this is another company I just started looking at. I actually bought a position in, and I'll probably do a video on it called Badger. It's a hydrovac play. It's a tuck-in hydrovac play. It's a Canadian one, actually, small cap. Could be interesting. I'm going to do a video on that at some point as well. But that one's not a value play or a commodity reversion play. Totally different idea. But anyway, and then you can see the rail right there. So they're positioned pretty nicely. Like when you get this adjacency to a rail line to get the product out cheap, that's what you want. So this is it is their biggest potash mine in terms of production currently. This is another one. They have quite a few actually by Saskatoon. This was one I wanted to look at because you can actually see a picture of it right from the Trans-Canada Highway. There you go. Just another plant. Again, I just like seeing them. Alright, and one of the reasons why, especially for this one, is when the CEO, and we'll go through the transcript of the investor day, basically whenever they talk about competitive advantage, they talk about the distribution network and their size, which is interesting, right? So that's their argument anyway, so I figured I might as well learn about the distribution network to try to help me see if that's true or not. You can see the 6 mines here, and then you have marine terminals going out, you have the 2 new terminals, and distribution points all over the place. 6,000 dedicated rail cars owned or leased. That was kind of implied by this picture where you can see the rail cars just lined up by the plant. Here's the 2 terminals, so again, this is helping them in their mind lower supply risk, but really it just helps them get more distribution to where it needs to go quicker, and also helps with storage and reduce lead times for key application windows. Basically, they're trying to use it to take share. Again, you have, of course, storage capacity here, again, close to the railway. Nitrogen, again, a large part in Alberta, but also quite a bit in the US. Again, they have dedicated rail cars, and they have short-term chartered ocean-going vessels serving 3 countries. So they have a pretty good distribution network. Here you can see kind of what they're trying to do in the future, and they're going to try to keep pushing more urea because they're getting higher gross margin per product in that space. So they're going to keep allocating capital and brownfield projects likely to the urea space to get that sales mix margin up and continue to leverage the distribution assets. So that's kind of like the play that they're doing here. I did think this is on the retail side of crop nutrients and crop protection. Those 2 things that it sells. It sells seed too, but it's not a big driver. But you can see proprietary products gross margin versus third-party products are 2x. So when they can sell their own products versus third-party, they make a lot more money. Margins are a lot higher. And currently, proprietary products as a percent of their total products sold is only 23%. So if they can keep basically selling their own products instead of third-party products, then they can continue to grow margin on the retail side. So that's worth bringing up too. Those are kind of things that they're going to try to do. This is on their investor day. These are things that they're trying to do in the future. So commodity prices go up and down. This is what their game plan is. And they're also going to cut costs of a couple of things. So in terms of the 4 segments, they have over 2,000 selling locations, blah, blah, blah. We kind of talked about the cotton nutrient and crop protection products. And that's just kind of what they do. Again, I guess I should have started this. The headline that they have is Feeding the Future. So this is totally about farmland and growing food, helping farmers out. So really it's the demand slowly goes up over time, basically probably in line with population growth, I imagine, assuming people eat the same amount. We'll have to see how that plays out over time, but generally speaking, long run, you should see demand slowly increase with population. So as long as the population of the world keeps growing up, you should see demand slowly go up. That's kind of like a little Coles notes there. Here we talked about the 6 mines already in Saskatchewan for potash. We talked about the rail cars which showed up, and then the marine terminals as well, which they're also interesting enough, kind of like ATCO. I think they actually started buying parts of the ports, which is interesting. Nitrogen, one of the things that is unique with nitrogen here is that 85% of their sales volumes have access to lower cost natural gas is one of the key drivers of cost. So it's actually partly have helped them as the commodity prices that they're selling have fallen down. So did natural gas at the same time. So nitrogen kind of has this natural rider, not always correlated like it has been, but it has been well correlated in the past, especially lately. So anyway, that's worth bringing up here. So they do have a lower cost here on the cost curve for nitrogen, partially because of lower natural gas prices. And then we talk about the frost fade in the US. But again, for our purposes of this video, partially because of time, partially because of size, I'm just going to focus on potash and nitrogen and retail. So this slide is just a whole bunch of information, but I just thought this was interesting because a lot of people know that potash is big in Canada, but I don't think appreciate that 36% of the global production for the entire world comes from Canada, which is huge, right? You have the competitor Russia at 12, Belarus at 12, Russia at 19, Belarus at 12. So bigger than both 2 and 3 together is Canada, which is relatively small relative to the world, right? So what I like about this is because so much of the production comes from Canada, which really comes from Nutrien, that they have pricing power in their own North American market anyway, or at least that's what I'd argue. What I mean by that is, so when they cut capex themselves or increase capex themselves, it's them themselves that might be moving the price up and down. So that's going to become important because when I talk about the cyclicality of the commodity cycle, because they have a little bit of control on their own production, they likely have control on the ultimate price. Now that may or may not be true. It depends on demand as well, but as long as demand slowly goes up, I bet you they have a nice little oscillator here between producing as much as they can to lower the cost, but also making sure that the price at the end of the day can slowly go up over time so they can make a decent return. So this is what I'm pointing out here because it's one of the unique things about Canada, and it is the critical segment, the biggest segment in terms of EBITDA. One of the things they are doing is they're continuing to automate to cut down on cost. So we're seeing that here. And one of the things that I need to see when I want to invest in a commodity play is I need to see capex going down for the biggest players in the commodity space. So much like 2020 and 2021, when people were, or really 2020, for the last part of 2020 even, companies were still pulling capex. And that's when I knew it was still a good time to buy because companies were still seeing that price signal of, oh my God, the prices are so low, why would I invest? And they're all cutting capex at the same time. Now, Nutrien here is also doing that. So we're seeing that ramp up production. It's pausing that ramp up right there. So that's what I like to see. In terms of what else I like to see, so we're seeing, again, 2022 was a crazy high year, but 2023, we saw the EBITDA just drop off a cliff, and we're seeing relative weakness again in 24. So we're seeing 2 years now of EBITDA declines, partially from an inflated sales price in 2022. basically when Russia invaded Ukraine, we saw commodity prices spike, especially for Nutrien products like potash, which Russia produces quite a bit of, as well as Belarus, as we saw on that pie chart. And so these prices just shot up, and Nutrien was a beneficiary of that, and now we're on the other end of that. So now the stock price shot up too high that it should have, because the market's overly concerned about the short term, like we talked about in prior videos, and now it's going to be overly concerned as the prices continue to collapse or go down. So that's, and then the stock price will overreact on that side too, which probably is starting to now, but that's why we're doing the video today, so we can keep visiting this as this plays out. In terms of the production, again, I want to see when I'm investing in a business that's commodity, I want to see these declines. So we're seeing the sales price collapse, we're seeing gross margin collapse. What I wanted to see is kind of what was their strategy here, and they just decided to keep production the same despite the price collapse. So basically, they're trying to take share from lower, because they're in the top quartile, I believe, of their cost curve. They can basically, the people that produce at a higher cost will get carved out as the sales price collapses, right, and they get pulled out of the market. They have to curtail production, and I think this is one of their strategies to try to squeeze out competitors, especially the smaller guys that have a higher cost basis. I think that's what they're doing here. Ultimately, it hurts everybody, and they should, technically, if everyone was cutting production at the same time, the prices would be higher, but this is not the goal here. And to be fair, this also helps the cost per ton when you shoot production up. We talked about that when we did gold miners with the all-in sustaining cost. But anyway, here again, nitrogen, same idea. Sales price collapses, margins collapse. And so I actually look for that, right? So I'm like, okay, am I likely no longer overpaying for something? Is this sustainable at the current price? Probably not, but we don't know that yet. Again, phosphate to a lesser degree, we've seen a decline in sales price. So that's what I'd look for. Again, this is just how it was slowly going up over time. You can see the trend line, and then COVID, and then the Russian invasion of Ukraine. So big pump up here, and now we're on the other end of that. We're actually already back down here. When I go to this, this is just MOP, but you can see the same trend, right? Back down to more normal levels. We'll talk about what they think in a second, but basically they think cost to produce a ton has gone up for everybody in the industry. And so they think that the current prices here are not that sustainable in the long run because the cost to produce has just gone up so much since 2020. So basically part of the inflation is in the channel forever. That's worth bringing up here. Again, what I like to see is all the inputs going down at the same time. They are. Again, we're back down to almost where we were pre-COVID. So again, that tells me we're kind of reverting closer to a decent time to buy again. Mainly because the cost to produce has gone up for everybody. So that even though the prices have come back down, that means the margins on the producers are getting squeezed, which means we're going to see a price signal that doesn't need to go as low as it did in the past in order to curtail production. Or at least that's what I believe. Here, so another thing I look for when I'm thinking about investing in a commodity play is, are they still lowering guidance? It helps me know that it's not all priced in yet when they're still bringing down numbers, and the analysts still bring down their numbers, and so it basically allows me to know that there's still time to continue to familiarize myself with the operation. So that's what this is. It's just them showing that they're still reducing their guidance range for EBITDA. Another thing I look for is these write-offs. So we saw this with the oil and gas. Actually, I think we did an Enbridge video where we had impairments. Right, because they have a very steady business, Enbridge, and we saw like the EPS in terms of accounting EPS just get destroyed during one part, and it was basically because of impairments. And what I like to look for during the times of commodity pressure is the impairments, because that will shoot the accounting EPS down the toilet, and especially when you get this for 2 years in a row now of impairments, it tells you that the things have been bad for a while in the industry, usually. I mean, this one's specific to Brazil, but they have been impairing for a while now. So that means it's in the comp set, which is exciting because eventually they're not going to be impairing anymore. Even if, say, if the prices just flatline, year over year next year, they're going to show up better in terms of accounting EPS trend. And I think that will also help whenever the impairment stop, which usually is impairment due to price. So we saw that oil companies do it all the time. Here's the cash flow. So one more important, CFO. Still down, but starting to stabilize on the 6 months, which is interesting. And we are seeing the capex finally react. So this is what you want to see in a cyclical business is the capex shoot down. Again, because we know Nutrien can influence the price of at least potash, in my view. The lower capex will support a higher price in the long term. And we should expect other businesses, if Nutrien's doing this and they're in the higher 25% of the cost curve, you got to believe that the companies that are in the bottom 25% of the cost curve could all but cut in production at the current prices, right? We don't know that. It's probably still trying to produce to cover their fixed costs, but anyway, it's definitely a good sign that I like to see. It basically tells me at least we're starting to see the capex response, and that happens, right? So the commodity price shoots up, capex shoots up, commodity price collapse, and capex pulls back. It's the price signal, supply demand in the market, and one leads the other, and this will lead a lower capex will lead to higher prices in the future, and that's just how all commodities have been. We've done this for a while now. And then what do they do with the cash? We'll talk about the buybacks. They did a lot of buybacks when they had a lot of cash. You can see they stopped it recently again, and that's one of the unfortunate truths of the cyclical industry, and we saw that in other industries as well. You can see the steady stream of impairments of assets, like I already talked about. So now you have 2 years worth of impairments, again shooting down the EPS that's reported, but in terms of non-GAAP EPS or EBITDA, not a big deal in the big scheme of things, but ultimately, Nutrien's deck is going to say potash demand will grow. And to be fair, you can see it every 5 years it does grow. Again, I think that's just indexed to population. The more people that eat, especially the more that consume more, you should see a continuing demand of potash over time. Now, this is them saying that both the short and the long run costs have gone up for the whole industry. So that's another reason why I think, well, the prices have gone back to where they were pre-COVID. The break-evens for the producers have gone up for all of them. So I think this will be very interesting as we work its way through, because we don't know how low the market price will go, but we know that even at the current prices, technically the producers are getting more squeezed than they were in 2019 or 2018, right? Because the cost to produce it has gone up. So it's just worth bringing up that maybe the price doesn't have to go as low as it did in prior cycles for it to start rebounding, which is why I'm starting a position already, right? Which is why I showed you. It's hard to time these things. It's more like a process, a auditing process in the capex and the commodity prices. Here's production. So this is the supply required to meet the growth. They think Canada, we could put quasi them. You can see that they're slowly going to step up production back half of the decade. It's worth bringing that up here. Again, this is just them showing on the nitrogen side that the cost of produce has also gone up. Here's something that's critical to me to make this investment now is, well, the share price looks like it's back down to 2019, 2018 levels, basically in line with the commodity price. But one of the things that's neat about Nutrien is that during the windfall of the high commodity prices, right, COVID and the invasion of Ukraine by Russia, they were able to buy back 23% of the business. So while the share price is back down to 2018, 2019 levels, there's technically 23% less shares outstanding. So that's what I like. Now, this is the thing, commodity producers always do this. Is when the things are good, they decide to buy their share price, or they have extra cash, they buy their share price, and unfortunately, their share price is high because times are good. Now, like, they could buy probably almost like, I don't know, maybe 30 or 35% of the business at the current price, maybe even 40% of the business, I don't know. But if they kept the cash and used it today with the current share price, right? So that's just the share. That's all commodity producers do it. The oil and gas companies kind of learned it a bit, hold some extra cash over the last cycle, just to be more prudent. But anyway, I always hate seeing that, like, they buy shares when they could instead of when they should, right? Whereas they could have just waited for the commodities to come back, which it always does, which they probably know, and then they'd probably buy themselves even more of themselves. But you can see this here in the share count too, 625 down to 495. From the outlook for. And then this, it also sounds like a sore thumb when you see 20 billion in revenue, 27 billion in revenue, then all of a sudden it jumps to 37 billion in revenue, right? The gross profit shoots up from 9 billion to 15 billion. So obviously you're over earning in 2022 from the higher prices, and now we're on the flip side of that where they have to deal with the normalization of prices. Well, there's still cost pressure in the long run. Right, but it's just nice when you can see a business that bought back 23% of themselves in the last 6 years. So I like that. So while the share price is back down to the 60s, right? Technically, there's 23% less of the business outstanding. So we're getting a better price than in 2018, 2019. Obviously, the market's currently expecting more price weakness, which could be true, but eventually that's not going to be true. We just don't know how long that period will last, so how long this opportunity will be here, right? And how cheap it goes in the meantime. So all you got to do, or my strategy to do with Nutrien is familiarize it, and as it's cheaper, I'll just slowly add. That's just how I deal with these things. In the long run, it's a pretty stable business. I mean, just food, right? So it's literally required for humanity. This is more about the Brazil part, the write-down. Now, I did think this was interesting. So our internal analysis indicates that break-even prices above our mid-cycle potash price assumptions are required to support any new greenfield capacity, so new plants to come online, new supply to come online. So basically above mid-cycle. So I think they're assuming 400 instead of forecast. So that's very interesting because right now we're at 300. Basically, they're saying people will need to see more than 400 in order to start putting new capacity on. So I mean, the longer that prices stay in this 300 range, the more future supply is going to get sidelined, and will probably be even more meaningful on the upside. So the longer prices stay lower, the quicker, eventually, there'll be a bigger peak on the upside. That's just how I view it in my head. There's that. I thought that was interesting. This is a term of automation, so I was trying to see, like, okay, what's a catalyst to keep improving? And really what they're doing, they want to get, goes from 0 3 or 4 years ago to 23 to 22% today in terms of automation. Now they want to get to 40 to 50% by 2026. And that's about maintaining their position on the cost curve, which is sort of top quartile. So that's where I'm getting the top quartile from. It's from the management team on the investor day. But that's just kind of how I think about it, is just another way to keep costs down by automating what you want, and the biggest players in the industry are the ones that are going to have the capital to automate. Again, should protect their cost curve, which is what you want. The main thing, whenever you're in a commodity play, if you're scared, you kind of always want the lower cost guy, the last man standing, right? That's the same reason why we bought Tourmaline, same reason why we bought Suncor when those prices were lower, right? That's the same idea here with Nutrien. You want to be one of the more stronger companies that can be the last man standing if things got really bad for a long period of time, right? Because you avoid that permanent share loss or permanent capital loss risk in my mind, right? Because all the competitors that are under them will slowly go bankrupt if prices stay low for too long, which at the end of the day will just support the future price of potash because there'll be less supply available. So that's just like if things get really bad. That's why you always look for the best and biggest players at the lowest cost. So this was interesting. This is the the share price. They bought at a price of $75 on average. Now at 54. This is JP Morgan. Anyway, basically say you should have waited, which is true. But again, a lot of the companies, when they get the cash, they're like, "Oh, we'll do share buybacks, we'll do special dividends." Pay down debt. Pay down debt's always a good idea, but a lot of the times when they do a lot of share buybacks, usually it's when the company has extra cash, and that's why they have the cash for the share buybacks, is because the profits are so good because the prices are so high. And now you have the opposite end where you're not buying any of your shares back, and your company's performance is under pressure because of the commodities, but you have no cash because of the commodities. So it's all linked together, and that's just another point that I like to bring up. And then here he's talking about the competitive advantage. And again, the first thing they reference over and over again is the infrastructure and logistics network. So basically, they believe in their size, their distribution channels, ultimately where the production is cheaper to produce, good fertile, and strong land in Saskatoon or Saskatchewan rather, right? No scope and reach. 600,000 farmers, 150 million acres that we touch directly. There would be many more hundreds of millions of acres beyond that receive our product globally. So basically, they're just the size that they're at is their competitive advantage in their eyes. And to my eyes, it's partly the distribution channel, but partially just because they're so big in terms of the overall production that if they themselves, when they pull back capex, they likely move the future price of potash up. That's just how I like that play. It's kind of similar to Vale's play on iron ore. Again, interesting enough, both of those plays are currently at 52-week lows, and they're currently have links to Brazil, which has also seen pressure lately. So, in terms of investor sentiment, so maybe we have more time here than we think. But I wanted to get the video out, and I'm going to continue to familiarize myself with what I think the long-term supply-demand characteristics of potash and nitrogen are. It's just ultimately in their eyes, we show the investor presentation, they're all bullish on it. But anyway, that's my thoughts on Nutrien. It's a interesting company. I do plan to keep adding under 60 if it gets there. Usually these commodity plays tend to get cheaper for a longer period of time than what you expect, and then that's usually when they present the biggest opportunity. Alright, I'd like to know your thoughts on Nutrien, and have a great rest of your week.